But that headline masks the real battle brewing underneath. Out in Silicon Valley, the giants are cracking. QQQ, the tech-heavy composite, is down 0.5%. NVDA, the chip titan that has powered this entire synthetic boom, is off by over 2%. Microsoft is following suit. The narrative that only technology can drive this market higher is showing serious friction today. However, if you want to see where the cash is fleeing to, you look small. The IWM, Russell 2000, representing smaller, domestically focused companies, is up a robust 1.09%. This is a classic sign of rotation. When the big, highly valued megacaps stumble, money often flows into the perceived value and cyclical strength of the smaller players. It's a sign that investors are hedging against tech fatigue by betting on Main Street, at least for the moment. And look at the individual movers telling the tale. Tesla, defying the tech slump, is up over 1%, while Amazon posts a strong gain near 2%. The narrative is splintering. It's not a market-wide rally. It's a highly selective hunt for winners amidst the uncertainty. The data only tells half the story. The other half is being dictated by the people who run the printing presses and the world's largest investment houses. The political stage is setting the geopolitical backdrop. We have Donald Trump weighing in on global affairs, providing the usual dose of unpredictable commentary that keeps bond traders up at night, specifically regarding matters like Venezuela and Greenland. When the political stabilizers seem loose, risk aversion tends to creep into the system. Then there are the architects of monetary policy. Jerome Powell, our Fed chair, is in the crosshairs. While the Budget Office suggests rate cuts might be on the horizon in 2026, that is an eternity away in financial time. Meanwhile, Christine Lagarde is grappling with Europe's own perils, facing the reality of missing the interest rate surge that the Fed has experienced. Different central banks, different pressures. But let's talk about the titans of capital who see further down the road. We have Jensen Huang delivering bullish forecasts for NVDA well into 2026, a clear signal that he believes the underlying AI structural growth remains intact, even if the stock experiences a near-term pullback. Conversely, we have Michael Burry chiming in with his characteristic doom, suggesting we are heading for something worse than the dot-com crash. These contrasting viewpoints, Huang seeing structural permanence, Burry seeing ephemeral froth, are what create the volatility we are witnessing today. And of course, the Bitcoin evangelists are loud. Michael Saylor predicts BTC at $21 million by 2045, while Cathie Wood suggests the US government might actually begin stocking a national Bitcoin reserve. These aren't fringe theories anymore. They are high-profile bets that challenge the very foundation of sovereign currency. Larry Fink changing his view on Bitcoin certainly adds mainstream legitimacy to the digital gold thesis. The VIPs are deeply polarized on where the future store of value lies. Now, let's move from the noise of equities to the sober reality of fixed income. This is where the true pulse of systemic risk is measured. The 10-year Treasury yield, represented by carat TNX, is screaming louder than most sectors, up 1.09% today, now sitting at 4.18%. What does this mean? It means the cost of money is rising again. When the safe haven bond yield jumps this sharply, it acts as a gravitational pull on stock valuations, especially for high-growth companies that rely on future earnings being discounted at a lower rate. This rising yield environment is the primary antagonist crushing the valuations of those flatlining mega-cap tech stocks we saw earlier. And look at the VIX, the fear gauge. It's up 1.49% to 15.68. This is not panic territory, but it's definitely not complacency. The VIX is elevated precisely because the bond market is yelling about inflation and future borrowing costs, while the stock market is trying to argue with the premise. The VIX is the uneasy truce between the two. The macro data confirms the structural tension. The impending US CPI figures and the December jobs report are the next major battlegrounds. We are waiting to see if the labor market, the crucial engine underpinning US consumer strength, is finally cooling down to allow the Fed to ease off the brake. However, the longer-term expectations are fascinating. The expectation for Fed rate cuts in 2026, as reported, signals that the market believes the current high-rate regime is sustainable for the immediate future, but that structural economic deceleration will eventually force their hand. Crucially, we must factor in the global dollar strength. The dollar index, DX, is up slightly, holding at 99.03, and the euro is weakening against it, trading at 1.16. A stronger dollar tightens global financial conditions, making it harder for international borrowers, and often US multinationals, to service their dollar-denominated debt. This strengthens the argument for continued caution in risk assets. Commodities are telling us one of two things. Either inflation is still baked into the system, or geopolitical supply fears are overriding economic slowdown worries. Oil prices, CL equals F, are up 0.81% to $58.23. This rise, despite tech weakness, suggests underlying energy demand resilience or perhaps geopolitical risk premium being priced in. If growth were truly collapsing, oil would be struggling more profoundly. More telling is gold, GC equals F. The metal is up 0.75% to nearly $4,483. Gold rallies when confidence in fiat currencies wanes or when systemic uncertainty spikes. Given the Fed's forward guidance and the rising dollar, gold acts as a counter-narrative, a vote of no confidence in the immediate stability of the monetary system itself. It's a traditional safe haven hedge making a strong move while the VIX is only marginally elevated. Let's circle back to the sector action, connecting the dots between the VIP commentary and the price action. We saw the big tech names, NVDA, MSFT, AAPL, all dipping, seemingly reacting to the rising bond yields punishing their future cash flows. Elon Musk's ongoing drama with Grok AI and image deepfakes is just background noise for TSLA, which is managing to climb 1% today, likely riding the general optimism we see in the small cap segment, or perhaps due to some specific positive commentary not yet reflected in the mainstream data feeds. The divergence is key, large cap tech taking a breather, while Amazon, plus 1.96%, and the small cap IWM surge. This suggests investors are still chasing growth, but they are prioritizing tangible earnings or smaller, potentially undervalued names over the highly speculative, high multiple growth stories. Warren Buffett's enduring outperformance, mentioned in the headlines, is the textbook definition of this value-oriented, cash flow-focused philosophy winning over time. The digital assets are certainly feeling the pressure of the stronger dollar and rising yields. Bitcoin is down nearly 0.90% near $90,220, and Ethereum is slightly worse off. This inverse relationship with the 10-year yield is holding firm. When the risk-free rate rises, speculative, yield-less assets like crypto often get bid down. However, the VIP commentary offers a fascinating long-term divergence. While the price is down today, the thesis remains strong among key proponents. Ray Dalio is hammering the message of dollar debasement, a core argument for Bitcoin. Michael Saylor is projecting astronomical upside. This tells us that the current price dip might be technical, driven by macro interest rate sensitivity, rather than fundamental disagreement over Bitcoin's role as a hedge against sovereign currency risk. The headlines suggest a market searching for its next catalyst. We have institutional insiders making significant sales in some stocks, even as others surge 150%, highlighting hyper-selective stock picking divorced from broad market trends. The focus next week shifts heavily to inflation data and earnings reports from major US banks. If CPI comes in hotter than expected, we could see the carat TNX blow past 4.20, which would put immense downward pressure back onto QQQ and the tech giants, likely dragging SPY down with it. If the jobs report shows sharp cooling, the bond market might rally, yields drop, easing the pressure on growth stocks. What are we seeing today? We are seeing a market cleaved in two. On one side, the behemoths of technology, the AI darlings, are pausing, perhaps succumbing to the gravity of higher discount rates signaled by the bond market. On the other, smaller domestic businesses and defensive assets like gold are showing resilience, funded by a rotation out of the top-heavy index leaders. The complexity here isn't chaos, it's calculus. Investors are navigating rising borrowing costs, uncertain central bank policy paths, and strong, yet divergent, signals from the world's most powerful voices. Today was a day of re-weighting risk, moving capital from the speculative high ground to the stable, hard asset reality reflected in the strength of the IWM and gold.